So what is the Social Security Tax Torpedo and how can you avoid it? That's what we're discussing in today's video. Okay, so in today's video, we're going to cover how to avoid that Social Security Tax Torpedo. And to do that, we're going to first cover what the tax torpedo actually is. Then we're going to cover a concept called provisional income, which is how the IRS determines how much of your Social Security benefits are taxed. And then lastly, we're going to look at some real client case studies, okay, and how all of this actually plays in and how you can use this information to reduce your taxes in retirement and, most importantly, avoid that tax torpedo. I'm Jose Armenta, and this is your Federal Employee Benefits, where we cover topics in helping FERS federal employees like you make smart financial decisions. Now, if you're new here, make sure you hit that subscribe button so you don't miss any future videos. And if you're a subscriber, welcome back. So what is the Social Security Tax Torpedo? Well, that's a term that refers to the act of pulling out a small amount of money or a smaller amount of withdrawals in retirement and having that trigger a larger amount being included in your taxable income. So for example, let's say you rely on $85,000 in retirement, right? That's your retirement income is $85,000 a year, and you pull out, let's say, an additional $10,000 for a large purchase, or perhaps you're performing some Roth conversions as your tax planning strategy. Well, that additional income, that additional $10,000 can trigger a larger amount of your Social Security benefits being pulled in to your taxable income in that year. So let's say you pulled out an additional $10,000, and that could trigger an additional $20,000, $30,000 of your Social Security benefits being taxed in that year. So your income, your taxable income that year effectively grew by $30,000 or $40,000 when you really just pulled out $10,000 of income. Okay, now to understand the tax torpedo better and how it actually happens, you need to understand provisional income, okay, which is the concept of how your Social Security benefits are taxed, okay, the percentage of your Social Security benefits that are included in your taxable income in any given year. So what provisional income is, the way that the IRS calculates this number is it takes basically all of your income. So your taxable income, your first pension, that's pulled in. Any investment income, right? Dividends, interest, that's pulled in. Capital gains, that's pulled in. Any rental income, that'll be pulled in. And when I say rental income, I mean any NOI, net operating income, right? You need to have a operating income for the rental property for that to be pulled in. If you're operating at a loss or a paper loss because of depreciation, then you're not going to pull in any rental income. Okay, any tax-exempt interest, right? If you have municipal bonds, that interest is pulled in. So basically, all of your income is pulled in. Okay, and once you have that number, you add 50% of your Social Security benefits, and that gets you your provisional income. Okay, then that number, that provisional income, is then applied to thresholds to determine how much of your Social Security benefits are included. Now, I've done another video on how to reduce your Social Security, the taxes on your Social Security benefits. Okay, go ahead and check that out. I go into a deeper explanation of the provisional income and how that's calculated. But that's just a quick summary. Okay, that's what provisional income is, and that's how the taxability of your Social Security benefits works. Okay, there are thresholds. The more provisional income you have, up to 85% of your Social Security benefits can be taxed. So another way of thinking about this is your Social Security benefits are 15% of your Social Security benefits are tax-free no matter what. More may be tax-free depending on your provisional income. Okay, the more provisional income you have, the more of your Social Security benefits are pulled in and taxed. Okay, now that we're all on the same page, let's look at an example of how pulling out more income, okay, more taxable income, can increase your taxable income by a lot more. Okay, and so in this example, we're looking at John and Jane Doe. Okay, they're in retirement, and their income composition is as so. Okay, they are taking out $15,000 distributions a year from their traditional IRA or traditional TSP. Their taxable pension is $24,000 a year. Their gross Social Security, so their total Social Security benefit is $36,000 a year. Okay, so their income is $85,000 a year. They're also taking out, in this example, we'll say they're taking out $25,000 or $20,000 in Roth distributions, which won't show up on your tax return, okay, if it's a qualified distribution. So we have the 36 plus the 24, that gives us our 60, 1575, and then plus 20,000, so they have 95,000 of retirement income in this example. Now let's say, okay, they pull out an additional $20,000 from their TSP for, let's say, a Roth conversion or to buy a car, okay? So they're gonna pull out $20,000, okay? Well, you'll see that their taxable income does not increase by 20,000. It increases by a lot more. And in fact, before we do that, let's go over and pull up this tax report, okay? I like to go over this tax report with my clients. It shows a lot of great information. So you'll see here at the bottom right here is that their total Social Security is on the left, 36,000. The amount of the Social Security benefit that's taxed is 17,050. Okay, so about 50% right now is being taxed. Again, remember that up to 85% of the benefit can be pulled in and taxed. Total income right now is 56,050. Okay, that's the amount of income that's shown on the tax return. That's including the amount pulled in from Social Security. That's including the IRA or TSP distributions. That's including the pension. When you apply their deduction, their taxable income is $25,300. Okay, that's an important number to remember. $25,300. Total tax $2,572. Now, if we go back over here to this screen and we add in that additional $20,000 that they're going to pull out this year from their TSP, let's see what happens. So an additional 25, that's going to put us up to 35,000. Close that up. Let's pull up the tax report now. Okay, let's start again in the bottom right. So 36,000 of Social Security benefits. Now look at that. 30,600 is now taxable. So they went from about 50% of the Social Security benefits being taxed to 85% of the benefits being pulled into their taxable income. The taxable income increase, okay, to 58,850. Okay, now their tax bill has more than doubled. Okay, you'll remember that their tax bill was 2,000 and some change. Now it's 6,000, so it has tripled. Okay, their tax bill has nearly tripled from pulling out that additional $20,000. Okay, so that's the tax torpedo. That's the Social Security tax torpedo. Is that when you're receiving Social Security in retirement, just pulling out a taxable amount from your TSP or your IRA can pull in additional Social Security dollars into your taxable income. Okay, and so you're going to see a greater amount of Social Security coming in and being a factor in your taxable income, increasing your tax bill substantially. Now, tax planning is critical in retirement, right? It doesn't make any sense to have invested and built up wealth over your entire career just to give up half of it to Uncle Sam once you retire. Okay, so you really want to have an efficient retirement investment strategy, okay, but also an efficient tax planning strategy, okay, so that you can keep more of what you saved and earned. Now, the line in the sand, really, okay, where a lot of this planning should be done before is your RMD age. Now, for most of you watching, that's going to be 75. If you were born in 1960, your RMD age will be 75. Okay, this changed a couple years ago. Now, if you were born before that, if your birth years before that, then your RMD age is likely 73 and might be even younger than that. But for most of you, it's going to be 75. Okay, that's the line in the sand. That's when you really want to do this planning to avoid some major tax implications. It's before that age, before your required minimum distribution age, when the Uncle Sam, when the IRS is going to require that you start taking distributions from your traditional accounts, right? Your traditional TSP, your traditional IRA. You're going to have to take a minimum amount out of those accounts starting at your minimum retirement age, RMD age, okay? So that's really the line in the sand. It's really what all of this planning needs to be done before that time. I hope you enjoyed the video. If you did, hit that like and subscribe button. And if you're interested in learning how my financial planning firm can help you with your financial planning and retirement needs, go ahead and use the link down below to visit my website and schedule a free consultation today.